Mohnish Pabrai. Mohnish Pabrai is a very successful investor in his firm Pabrai Investments. He's a big fan, and he's very clear about being a big fan of Warren Buffett and Charlie Munger, which I think is something that aligns perfectly with what us as financial analysts try to achieve as objective. Those who were in the call before might be puzzled by us talking about blackjack. One of the things that one of his achievements, and as he mentioned, he's very honored to be banned of a casino by having a strategy that wins in Las Vegas. But more to the point, in the conference, he's also the author of a couple books, the most famous of which is Dando Investments, which has been translated to a number of languages. The part where his card endeavors and his fine arts endeavors match, I think it's in one of his principles, which is to bet heavily when the odds are overwhelmingly in your favor. So without further ado, I'd like to not waste more time and to make the most out of picking Mohnish's brains, which I'm sure could be quite profitable.
Well, thank you, Javier. It's a true pleasure and honor to be with CFA Society Mexico members. CFA does a lot of good work around the world. I'm not sure I would be able to pass all the CFA tests. So thankfully, I was able to set up my business without taking any of the CFA exams, and somehow have been hacking my way through. I think you get a lot of benefit and discipline when you go through the CFA program. It is pretty demanding. I think we could keep this in a Q&A format, if that's what you prefer. You can talk about pretty much anything you'd like to, anything you have in your mind. I think I might hesitate a bit on is just current portfolio position. Other than that, it's open season. The more time we spend talking about blackjack, the happier I am. So that's okay too. So please feel free. And if you could just, when you ask a question, just tell us a sentence about yourself. That'd be great.
Okay, well, actually, I would probably like to start,
right,
since I already have the mic open. It's great to have such an open conversation with a successful value investor. I would say I'm a value investor. I'm the treasurer at Scotiabank in the daytime, guitar player nighttime, and very, very occasional card player. That's gonna disappoint you because I feel the odds are in my favor. I don't like betting where the odds are in my favor. But going into the conference topic, into value investing, I mean, in my experience, and I had, I guess, like most people, a couple of great successes and a couple of great failures. But what I see is, usually when you look at a company or industry, and the multiples are like overwhelmingly look good. First I started and I found all the companies that had legal troubles and all these asbestos suits. And then I kind of started reading the legal part of that. But usually what I see, and that's where I'd like to pick your brains, is that usually when you see something that has like a really low price earning, has had strong earning, and sounds like a stable business, and all the things that you're looking for, looks like when you go into these stocks, barring a couple of great exceptions, which are usually like forgotten stocks, the market seems efficient-ish to me, in the sense that once you're in, the bad news start coming in that justify such a low PE or whatever opportunities seem to be there. So I like to, what would be like your tips into finding the real businesses from the value traps would be the bottom of the question, I guess.
Yeah, Javier, that's a great question. And I have practiced different styles of investing. They're all within the value investing tent. It's a very large tent. And within that tent, you can do many, many different things. For example, recently, Buffett was buying the stock of Activision Blizzard, which is in the midst of being acquired by Microsoft. And the market believes that deal will not do. And so the spread between the price that Microsoft is willing to pay and the price at which Activision, I haven't looked at it recently, but the price at which it was trading or is trading is a very wide spread. But Buffett mentioned at the annual meeting that the reason he bought the stock is purely merger arbitrage. He believes that statistically it is high probability that that deal will close. And if it does close, you capture that gap. We have a similar gap with Twitter, where Elon Musk has, asked or, has a deal to buy the stock at a particular price, and the market doesn't believe that that's going to happen. A lot of people believe that he can't get out of it, which we will find out in a few weeks. So I think both of those cases would be part of value investment. You had some reason to believe that these were high probability events, that Activision Blizzard is likely to be bought by Microsoft, and the Twitter deal might get done. Maybe there is a small adjustment that mainly gets done around the price that was agreed, and you made those bets, then that's a very valid way to go about it. What I think is the best way to invest is to focus on the great business. There are many things. You could do merger arbitrage, buy a business that's trading well below liquidation value, maybe below cash. And there are a number of different ways in which you can protect downside. But generally speaking, the way you will make the most money is by the partial ownership of a business which has tremendous economics and a tremendous run. If you are in the happy position of the ownership of a tremendous business, a tremendous runway, for the most part, you only need to be right once or twice in a lifetime, and it would cover a lot of sins. Recently, there was a lot of coverage about an Indian investor, Rakesh Jhunjhunwala, who just passed away. I didn't know him, but I have friends who were friends of his, kind of a friend of a friend. Rakesh was 62 years old. He was in poor health. He passed away with a net worth of over $4 billion. All of it was from the market, and he never managed outside money. I mean, if he had decided to open an investment advisory business, billions of dollars would have come to him. But he wasn't interested. So he just managed his own money. And when he first started, he's a chartered accountant, a CPA. When he first started, maybe in his early 20s, about 40 years ago, he had no money. He was absolutely zero. He went to this lady and requested her to give him a loan of about $25,000 so he could buy some stocks. So the lady told him, if I give you this money, what is the guarantee? What guarantee can you give me? What collateral will I get? So he said, look, the only collateral I can give you is my signature. I have nothing else. I have no assets. So you should only give me the money if you trust me. So she didn't fully trust him because he's an unknown guy. But she tells him, okay, listen, here's what you do. You take the 25,000. I'm going to first give you 12,500. You go buy stocks with the 12,500, and then you give me those shares. I will hold custody to those shares. They are your shares. The upside belongs to you, but that's my security. So he said, done. He also agreed to pay her 18% interest for the money, which is, I would say this was a different time, probably early 80s. Normally, in India, you would borrow at 13%. Rakesh paid 18%. And then, he started to invest, and he was a kind of, I would say he was a split brain, a lot of rapid fire trading. But he also had two really long-term goals. So there's a company in India called Titan Industries, which I think he invested in maybe 20 or 25 years ago. And when he made that investment in Titan Industries, it was like 3 or 4% of his portfolio. He never sold a share till he died. He died with those shares. And out of the 4 billion, around 2 billion was Titan. And Titan compounded at something around 30%, 30 or 35%, along for more than 2 decades. And actually, if you study Titan, I don't want to go off track, members won't have much interest in studying Titan, but if you study Titan, basically it's a jeweler. And in India, the only jewelers you would do business with was ones that your family had done business with for a long time. So you could have some trust. Because when you're buying gold, you don't know if it's fake or real or whatever else. Titan was it was promoted by one of the large Indian conglomerates who was very trusted. And so they had natural trust. Indian jewelry was very fragmented. Now Titan is gradually consolidating that. It's, in my opinion, Titan still has maybe a 50-year run ahead of it. It's got a huge runway ahead because it's so. But to give Rakesh credit, company went through lots of ups and downs, but he understood the business. And when it became 10, 20, 30, 40, 50% of his portfolio, he was least bothered about it. Just kept it. And then there was another company, Lupin, which is the pharmaceutical industry. And I think Lupin became 25, 30% of it. So he was doing a lot of rapid fire trading every day. He had 3 screens in front of him, and all of that, and he'd buy stuff at 10 o'clock and sell it at 2 o'clock, whatever else. I think that was just to keep his mind occupied. Okay, very smart guy. But these 2 stocks, with the guy who's doing this rapid fire trading and had a view on the market and view on every wiggle that the stocks market is doing and so on, he never touched these. And the reason these companies did well was that they were great business. And he never sold them even when they looked optically overpriced. So Titan became a market darling. Everyone loved it for 20 years. They understand the story really well. And it's like Costco. Everyone understands Costco, everyone loves Costco or Walmart, and so on. But so one of the important things in investing, which is a departure from Ben Graham. While Ben Graham is regarded as the father of value investing, he also did, in my opinion, some disservice to us value investors. Because Ben Graham had an edict that was cast in stone. And the edict was that a stock should not be held above its intrinsic value. And actually, with due respect, and I hope you will pardon my blasphemy, the correct model, I believe, would be like the Buffett, Munger, or Chuck Akre model, which would be like Chuck Akre is a great example, and I think we need to see if we can get him to speak to you guys. Chuck Akre asked the question. He doesn't ask the question, is the stock above intrinsic value? He asked the question, is the business getting better? And if the business is getting better, then you need to give the order room. So let's say Titan is growing 15, 20% a year. And let's say the trailing multiple is a PE of 40 or a PE of 50, very high, right? According to Rakesh, it is very clear the business keeps getting better. The more stores they open, the deeper the moat gets because they can amortize their lines over a larger pool, and the wider the distance goes between them and their competitors. And so while you would not buy Titan at 50 times trailing earnings or 40 times trailing earnings, maybe even 30 times trailing earnings, you should not sell. So there is an asymmetry in investing which Ben Graham didn't talk about or probably even didn't believe in, where at a certain price, I would not buy a stock, but I wouldn't be wanting to sell. And so I think that when we make investments, so this asymmetry, between what price you buy a stock and what price you'll be willing to sell a stock at. So let me take a slight detour. The very nature of capitalism is that if someone has a great moat and is making supernormal profits, there are lots of incentives, lots of entrepreneurs businesses to go into that business to wipe out super profits. That is the nature of capital, which means that something like Titan going for 30, 40 years, Costco years, or Walmart or Southwest Airlines, these anomalies should not exist in capital. If you just took a theoretical point of view, they shouldn't exist. But they do exist. And the reason they exist, that when an entrepreneur starts a business, the best that they can do, almost all cases, is some what I would call arbitrage opportunity, which allows them to earn some finite period. So for example, if in the Polanco district of Mexico City, there are no sushi restaurants, and someone opens a sushi restaurant, they will do really well for a while. But once other sushi chefs figure it out and they start opening sushi restaurants next to this, those profits will start eroding. Now, if this sushi chef has some secret sauce where nobody can match his quality of food or whatever else, it could become an enduring moat that could go on for a long time. So enduring moats are very hard to predict when you start. But what happens in capital sometimes is when you look back, you can identify enduring moats that somehow got built and even look like they might persist for some time. And those are the ones to focus on. So one of the reasons the index is so hard to predict. So there are literally just about 4 or 5% of companies that generate almost all the returns that the index gives. In the stock market, if you took out those 4 or 5% companies, the market returns would be terrible. When we as individual investors are picking stocks, the odds are stacked against us because you have to pick one out of them. And the odds of being wrong, and especially, you put on a cheapskate hat and you're trying to buy something cheap, and then you're trying to pick one of these 20 great businesses, cheap. Good luck with that. Very hard to pick. And the index does so well because the index is too dumb to know that it owns Google, too dumb to know that it owns Microsoft, too dumb to know that it owns Costco, and too dumb to sell these things ever. And so it just rides. So just like we saw with Rakesh, 3% of his portfolio, which was a really small piece, which was probably at that time maybe worth less than $50 million or $25 million, becomes $2 billion. Okay, and what did he do? The biggest thing he had to do was do nothing. So the holy grail of investing is we will make a lot of mistakes. John Temple said that the best investor will be wrong 2 out of 3 times, or 1 out of 3 times. Most of us will be wrong half the time. Even if you're wrong half the time, you can do it. It's a very forgiving. But the important thing is, when you find yourself in a happy position of ownership of a great business, you have to set aside that. And if you can see the runway, see that it's a great business, keep doing well, run by great managers, honest managers, then you just hang on to it your life. Now, if it gets egregious, so you can hold a business which can go overvalued, but you should not hold it egregiously. So we might consider Costco valued at 40 times or 50 times earnings, but we should hold it. If Costco went to 200 times normalized, it should have been sold a long time, because then now we've left it. So sorry for the long answer. That's kind of how I think about it.
No, I think it's great that it's a long answer, but it's a great answer. So I'd like to open the floor to see if somebody else would like to ask a question.
Yes, we have a question from Julio. What are your thoughts about DABA?
Well, I was hoping a conversation out of specific names. Well, I would say Alibaba is a great business. Got into the crosshairs of Chinese Communist Party. That's usually not a good thing. They have some very strong moats. They have great management. Probably the business does well. Beyond that, I think you should do your homework. And one thing I would just generally say is that given how large Baba is, how long a run it has had, or the length of period it has that run, it would not be my top pick, or maybe my fifth or seventh. So I think that there should be a lot of other businesses that should be a lot more active, with probably better economics than Alibaba.
Thank you. Mauricio Santos wants to make a question.
Hi, Mohnish. Thanks for the call. Thanks, CFA, for organizing this. I was wondering, what are your thoughts about active management? No, has it changed across the years? In my view, fees going down everywhere. It has become more difficult, no, to do active management. It seems to me that as a result of this, active management is being secluded to a smaller part of the market. I would love to hear your thoughts about this. How has active management changed throughout time? Thank you.
Yeah, I think that's a great question. So for a long time in the United States, we've had more mutual funds and ETFs than individual stocks, which to me is a stunning statistic. And I think we all know the stats that in active management, because the fees and frictional costs are a lot higher, almost a law of physics, that 80+% of active managers after fees will lag the index. So I think for the know-nothing investor, it is a very good idea to just index, because 80% chance that if you pick an active manager, you're going to pick someone who underperforms. So the picking of great managers is a really difficult exercise. I think picking great managers is much harder than picking great stocks. And so if the odds are set against us in terms of picking great stocks, they're set very much against us, managers. Fund management industry is interesting in the sense that 80% of the industry does not add value. It subtracts value, but it continues to exist. So it's kind of like someone sells a substandard product, but they don't go out of business, which doesn't happen in almost any other industry. Fund management is a little bit peculiar from that point of view, because the stickiness and recurring nature and so on. So I think it will continue. We will continue to have subpar managers, and we will continue to see 80+% of assets in places where they should not be. And such is life.
Thank you very much. Actually, that was a very good question, Mauricio.
Yeah, I have one question, and thank you, Javier, for moderating the panel, and thank you, Mohnish, for dropping by. What do you make of the argument that, actually, these two questions. So one is, what do you make of the argument that value investing is really a function of where you are measuring from? Because the entire value investing thesis is you pick theses that are down in price, hoping that they will go up. That works only if you make up for a selected sample of stocks. So that's question number one. So what do you think about that technical argument? And then the second is, actually, value happens in companies that are growing fast. So if you invested in FAN over the last couple of years, you did pretty well, and you created value. So at one point, the distinction between value and growth is more of a marketing strategy, and at one point, it's really something that is tangential that can be delivered by metrics and by looking at financial statements.
Yeah, I'll take your second question first. I might need the first one repeated. I didn't quite get that. Value and growth are joined at the hip. There is no such thing as growth investing without value. So all intelligent investing is value investing. The best kind of value investments are ones where the company generates very high returns on equity and has a very high growth rate and has a very long runway, which fits the description of many FANG stocks. Investing in FANG stocks is not some departure from value investing. It's actually very much within. In fact, if one had a crystal ball and one could see the future cash flows, let's say in the year 2000, 2002, that Google or Facebook or Microsoft would generate until the day they don't exist, till they disappear, and you were able to discount those back, that would give you a basis to invest in those, which would not be debatable. And it is entirely possible that these companies were worth investing in, even at a trailing earnings of 100 or 150, if the future cash flows suggested that. One could have bought Walmart at double or triple the price it was trading at many times in its history, still delivered double-digit analyzed. Even Buffett has said that when they bought See's Candy, which they paid like $25 million for, they've pulled out several $1 billion in dividends so far. I think when they look back, they say that they were not willing to pay a penny over what they offered, but they now say it was dumb, and they are thankful that the owners didn't walk away. But they said that in hindsight, they could have paid $100 million for that business, or $150 million, and it would have still been a great investment, 5 or 6 times. And that was a business at that time. I think the book value was like 7 or 8. So I think that it's in the nature of capitalism that when you get to these kind of really unusual businesses, and the fangs of a lot of unusualness about them, because they're in the business of converting atoms into bits. When you convert atoms into bits, and you have some kind of mousetrap that doesn't let others, get into your area of converting atoms into bits, you can do really well. I mean, if I look at the advertising market, it used to be that people used to say, some advertisers used to say, half my advertising works and half doesn't. I just don't know which half. So that is no longer true when you advertise with Google or Facebook. You know exactly what is working and you know exactly what is not working. You can pinpoint the results, which was not possible millennia before. And also a lot of it is consolidated. So a large portion of those advertising dollars end up in very few hands. And those hands that it ends up in have incredible moats. Now these moats can fill over and they can change over time because these are technology businesses. So I think it's just a matter of being able to figure out what is a sustainable moat, what are the likely cash flows, what are you paying for those cash flows. And if all of those make good sense and a high probability, then none of those investments are outside of value. If you could repeat your first question, I didn't quite get them.
Sorry, I was muted. Yeah. Now the first question is because this entire value versus growth sort of competition, the point that I was trying to make, obviously it depends on what benchmarks you use and what kind of analytics you do, but if you look at one period of time, stocks that are defined as value seem to perform better than are classified as growth and vice versa. But that's really a function, in my opinion, that's really a function of where you are measuring from. I'd rather prefer and I like much more your thesis about sustainable business models and forget about indices that try to categorize these stocks as values, whatever seems to be underpriced, and growth seems to be whatever overpriced. That was the entire point that I was trying to make.
Yeah, that's a great question. So Buffett has a quote that he says that we like to buy great businesses when they are on the operating team, where they have hit some hopefully temporary hiccup. So the nature of my psyche is that I can recognize that MasterCard is a great business. I may even recognize that it trading at 30, 40 times trailing earnings is perfectly normal. And it may even be true that paying something like 20 times trailing earnings might be a great price. But someone with my psyche would not be willing to even pay 20 times earnings for MasterCard. It just doesn't fit for me. And that's perfectly okay because this is not a game of called strikes. So in baseball, you get 3 strikes and you're out. Investing, you get 1,000 balls go. So I like Microsoft as a business. I don't like the class. So I could just focus on great businesses that are on the operating table. Okay? And when a great business is on the operating table, no one's interested. So it's kind of like when Buffett took the first large position in Geico, when he bought, I think, 40% of the company. There was a lot of fear that the business was going to die. They had done some bad underwriting. All their numbers were upside down and the surplus was gone and all of that. But he stepped in, changed management. He got some breathing room from the regulators. In that case, he was active. But there are many, many examples because it's in the nature of capitalism that companies don't go straight up, straight line. They are going to ebb and flow and they're going to have issues and hiccups and things that happen to them. And so if you have an understanding that whatever has happened to them is a temporary hiccup. So one of the advantages we have versus the market is the market tends to overweight short-term factors. And if we can have a more balanced weighting of the business over a much longer period, that can give us an edge against them. If we have the patience to hold much longer periods, that gives us another edge against them. So for an investor like me, I want to have my cake and eat it. So I don't want to pay up for it. It just doesn't work, even though it makes all the sense. I want to have the great business out there. And because they are 50,000 strong, and because there's some number of them that are on the operating table at any given time, if I'm willing to do the work once in a while, I'll get a business on the operating table that I can see it's a temporary issue. And it'll go away, and then we can do just fine. That can work out extremely well.
Hi, this is Marina Mendoza speaking, and I just have another question that probably is already implied in your previous answers, but I just want to get this straight. My question is, how do you navigate in this kind of like bearish scenario where we have like macroeconomics hitting, the screen every single minute? What are your takes on, the short-term inflation, the interest rate increases, all these new numbers that we hear in the States daily basis?
I think we have to overlay those numbers in the context of the business you might own or want to own. So let's say I own a business like Costco, for example, or a business like Amazon. So
are you having trouble finding a place for your precious bundle of
the price of oil affect Costco? How does inflation affect Costco? And I think the answer really comes out, if I really think about it. Yeah, oil prices go up, their costs go up, their customers spend more to get to the store. It's a negative. And inflation is a negative. You have less money to spend and so on and so forth. But when I overlay that, the nature of the business, which is that they have a secular structural advantage over their competitors. I mean, Costco opened 2 stores in China recently, last year or so. And the stores got more. Like they could not handle, and I don't think even now they can handle the volume of the crowds that want to shop at those stores. And those 2 stores for Costco in China are insanely profitable because the volumes are small. So how many stores will Costco have in 20 years? Okay, we don't know the answer. We know it's likely to be more than 2. It might be more than 200. It might even be more than 1,000. We don't know that. if Costco ends up with 1,000 stores in China, in the US they only have 800 stores. If they end up with 1,000 stores in China, that is a factor that has a huge impact on how well an industry does. So I think that when you find yourself in the happy place of the partial ownership of a great business, the best way to think about it is you think about it like it's your family business. And if your family owns 70% of Costco, somebody came to you and said, hey, can I buy your business? You would say, no, we might have 2,000 stores in China in 20 years. And we are only in 10 countries. And in 20, 30 years, we might be in 30 countries. And we might have 10,000 stores in 30, 40 years. Who knows? So, because the future possibly looks great, and the probability that the future looks bleak is pretty low, all the other noise coming at us is not relevant. Completely irrelevant. When Rakesh Jhunjhunwala bought Titan, the Indian jewelry industry is very fragmented. No one has even 1% market share. And if you fast forward 30, 40 years, Titan might be 25%. And nobody else might be even 2%. And that runway just continues. And so, to me, what is important is that those are the factors. That's really what matters. So, separate the signal from the noise and ignore the noise. And especially noise that you have a hard time even understanding or calibrating. So, who cares what the Fed does? Who cares what inflation is? Who cares what the price of oil is? Who cares what the outcome of the Ukraine war is, even though that's a very sad situation? There's a lot of things that don't really matter. And we should focus on the things that are likely to affect. The things that are likely to affect a business the most are factors around the business, not factors around the economy.
Great answer. Thank you very much for your time.
Sure.
Hi, Mohnish. Thank you for being here. Big fan here. I just wanted to ask you, what's your idea on where is value investing going in the future? It has changed since Ben Graham and the idea of the cigar butts, and now kind of value growth, And where do you think value investing is going in the future?
Charlie Munger tells me that if Warren and he were starting out today, they could not do what they did. He said that when they started out, they used to shoot fish in a barrel after the water had been run out. And so there was relatively few people looking at a relatively large universe of different stocks and assets. Now we have a lot of brain power directed towards, relatively narrow number of stocks and markets and so on. So anytime you have a large number of intelligent people with a lot of money looking at certain assets, you're generally not going to find a lot of mispriced opportunities. They'll still exist because if you think long term, that can give you an edge. I think you have to zag when people are zigging. For the most part, I think I have one stock I own in the US, and I own a few stocks in Turkey. No one has any interest in Turkey. It has 80% annual inflation on an official basis. On an unofficial basis, it might be even higher than that. And so everyone and their brother has exited. When I bring up Turkey to really smart friends of mine, who are really good value investors, who moan and groan that they cannot find anything to buy, they immediately dismiss it. I don't want to talk about Turkey. I want to talk about US. The thing is that there is always mispriced securities, underpriced securities in some area or segment that is usually hated on. And most people do not want to go into places that are hated in their life. But if you're willing to go to some of those places, so I would say in Turkey it's really simple. It's really difficult to invest in a place with 80% or higher inflation and do well in dollars. But there are some businesses in Turkey where all their revenue is in euros, or 98% of the revenue is in euros. And almost all their costs are in euros. And something like every 10% drop in the lira increases their euro earnings by 2-4%. So actually, high inflation is a tailwind. So, for example, there's a fruit juice company in Turkey. I don't own this company, just giving you an example, where 98% of the revenue is exports into the European Union. So Turkey is part of the European Common Market. It can export to the European Union with no duties or tariffs. So all their revenues come from euros from Europe. Their expenses are the payments they make to the Turkish farmers and the processing and all of that happen. Those payments keep declining in euros, and the revenues are stable. But it's been taken out back and shot because it's in Turkey. And therein lies the opportunity. So it might be like 2% of businesses in Turkey or 3% of businesses in Turkey that are listed have this dynamic of euro revenues, Turkish lira costs. And when everything was shot in Turkey, these were shot as well. So the Indian guy can go to Turkey, focus only on this particular metric. I want euro revenues, and I want lira expenses, and I want to pay 3 times this. And it's available now. And no one else is interested. Life is great. So like this guy, Jim Cramer, says, I'm not a big fan of Jim Cramer, but he says there's always a bull market somewhere. And I agree with him. So there is always value available somewhere, because there are 50,000 stocks. There are some stocks that are on the operating table. And there are some countries that are on the operating table. And if you're willing to sift through, it may pay off.
Are these companies you're talking about in Turkey listed companies, or is this part?
They are listed, Francisco, and they are waiting for your buy order. So I want to tell you something about Turkey you may find interesting. When I made my first trip to the country, by the way, I really enjoy my trips to Turkey. I've enjoyed my trips to Mexico City as well, but I enjoy my trips to Istanbul, because when I have the grilled fish on the Bosphorus River, which has just been brought in by the fishermen hours ago, nothing is better. So I can dine on the blue fish, and then I can go buy my food, and then I again go dine on the blue fish the next day. So on my first trip to Turkey, which was in 2018, I met this guy, CFO of one of the largest conglomerates in Turkey. And he says to me, Mohnish, you know that every country has a national game. You know what the national game Turkey is. Why don't you participate? So he said, well, you know, like in Russia, the national game is chess. In the US, national game is poker. In China, the national game is poker. And in Turkey, the national game is backgammon. They have all these kind of parlors, like video parlors, backgammon parlors, where people go and play backgammon. So he said, look, chess, purely skill, no luck. Poker, combination of skill and luck. Baccarat and backgammon, pure luck, no skill. Okay? So he said the Turkish stock market, 80% are held by insiders or foreigners. And that 80% doesn't. It's just static. There's almost no trading of the 80%. The 20% that is quote unquote free float with retail Turkish investors and institutional Turkish investors. That turns over every 9 days. So the trading volumes of the 20% float is completely turning over. I mean, if I look at a typical US stock, maybe the entire market cap changes hands 2 times in time. This is changing hands 35, 40 times. Okay? And it's not just 35, 40 times a year. Most Turkish investors, they don't even say I'm investing in the stock market. They say I'm playing in the stock market. They call it playing the stock market, not investing. Their model is, I want to put my money at 10 at $10 a share, 10 lira a share. And by 1 o'clock, I want to sell it for 11 lira. And next day, again, over and over. And this other CFO, this lady, very nice lady, she was telling me, I get these calls from retail investors. And they think they're like buying carpets. So they ask her, how much you want for 1 share? So she says to them, it's crazy. No, you tell me how much. Give me a good price. I buy it, okay? And after I buy it, how much can I sell it to you tomorrow? These are real conversations, okay? She says, I don't even know how to respond, okay? But this is what happened. So our friend Warren has a, he has all these papers. He has the operating table. He says the stock market is a mechanism to take wealth from the active to the inactive. And I look at this in Turkey with the CFO telling me about this nine days trading. I said, they want to give me their wealth. They are saying, please take my wealth. The Indian guy said, no problem, I'll help you. I'll take your wealth. Okay? So this, the trading volumes are really high. And the thing is, people are investing for 4 hours or 3 hours or 2 days or whatever. They don't really care about the business. They don't care what will happen with Costco in 20 years. That's not on the radar. Okay, they're concerned about what happens to Costco in the next 1 hour. Okay, that's really what they're focused on. So I see this company in Turkey, it's a warehouse operator, largest warehouse operator, 12 million square feet of warehouses. You could liquidate the whole business in 6 months, and you would get 700 or 800 million for these warehouses, very prime warehouses. The market cap when I first invested was 20 million. It was trading at 3% of liquidation. And I couldn't find anything wrong with it. My Turkish friend who took me to see the company who owned the stock, and it looked like a perfectly legitimate company. And I thought I'd never get any shares out of it. And because of this rapid fire trading, we own 1/3 of the company for $7 million. Hallelujah. And that 20 million, I think now is like 120 or 140 million. It's gone up a little bit. But the value of the business has gone up even more. Because they are like the juice seller. Either the leases are in euros or they are inflation. They are borrowing at lira, they're borrowing in lira at 14%, when the inflation rate is 80% or 100%. By the time they pay those lira back, they'll pay back 5% of it. Okay, but it's not a loan, it's a grant. The bank loan is just a grant. So they make money even on the bank. When we have a dynamic like Turkey, and when I find that nobody's in it, it's okay. Indian guy will do it. And the food is great. And the atmosphere is great. Everything is good.
Okay, well, thank you very much, Mohnish. I think we're 2 minutes away, so maybe we should be wrapping up. But I think it's been really insightful to hear you, especially in these times where value investing has become almost a meme in some corners of the investment world. But I tend to agree that
Thanks
in
for
the
watching,
long
guys.
run,
This is a mohnish pabrai question and answer with the CFA Society of Mexico, August 17th, 2022, 11 months ago.